It could only be bad news when investors are hitting the sell button too quickly, or when revenue just doesn't seem to add up anymore. Is it all bad news for Rivian Automotive? Let's look at why you should stop investing in Rivian stock and the factors that contributed to its fall. Founded in 2009, Rivian Automotive saw its stock skyrocket after the company went public in November 2021, making it one of the most valuable automakers in the world. The company has received positive reviews from the automotive community with its all-electric R1T, which was named Truck of the Year by Motor Trend in 2022. With an advanced manufacturing office in Surrey, England, Rivian is also set in locations that include Plymouth, Michigan, Carson, San Jose, California, etc. The bad news is although the automotive company ended 2021 with a market cap of $94 billion, this was almost completely wiped out within the first half of 2022. Let's first look at issues that have to do with soaring inflation and productivity. Rivian's production challenges forced the company to revise its production estimates of 50,000 vehicles to 25,000. The company plans on using net proceeds from the Rivian IPO for working capital to spark growth and fund other corporate purposes. CEO Scaringe has said that production ramp-up at the company is absolutely making progress, although supply chain issues continue to slow down production. You have heard of the global semiconductor chip shortage, right? Well, this is definitely the most painful constraint for the already struggling automotive company when it comes to productivity. Supply constraints forced the EV maker to hike the prices of its EVs even before it could start producing a meaningful number of vehicles. The public had some very strong sentiments that were vividly expressed via social media. Rivian had no choice but to roll back on its decision to seek higher prices from customers who had already pre-booked its EVs. The big blow came in mid-March when the company reported a loss of $2.5 billion for its fourth quarter against revenue of only $54 million, and said its parts and supplies would be enough to produce half of the estimated vehicles to be produced in 2022. Analysts predicted a 40,000 unit production, with the company itself asserting that it could have handled 50,000 if not for supply constraints. By mid-March, Rivian was trading at less than half its value at the beginning of the year. Perhaps this is why the majority of investors are selling. One major incident also contributed to investors rethinking their options when it comes to Rivian, and we will tell you all about that in a bit. Rivian laid off more than 800 workers in July. CEO RJ Scaringe told CBS Money Watch in a statement that the soaring inflation is hurting the company's bottom line and that layoffs are necessary for Rivian to achieve its goals of sustainable growth as we ramp up productivity. This is certainly not a good outlook for the company, and definitely not a positive sign for an investor. As an investment opportunity, you can have one terrible experience when investors are hitting the sell button too quickly. Dan Ives, the analyst for Wedbush Securities, perfectly encapsulates this by saying, "The report of Ford selling 8 million shares is not what any Rivian investor wants to see. Stock has been a debacle since the IPO. I think you are seeing with the lockup ending that investors are hitting the sell button in a jittery market." Once Rivian's IPO lockup period expired, Ford, one of its biggest shareholders, wasted no time in dumping its shares, bringing the company down from about 12% to 9.7%. Amazon also got the EV maker's IPO hyped up when it placed an order for 100,000 units of its electric vans, which the automotive company expected would bring in a significant portion of its revenue in the near term. Imagine the nervousness of Rivian investors when the e-commerce giant stuck a deal with Stellantis in January to purchase its battery EVs in 2023. What then are we to expect from the EV company long term? A miracle? Let's find out. According to a report by The Verge citing company officials, Rivian has nixed its less expensive pickup Explorer RAT electric pickup truck model, which started at $67,500. The company sent emails to its customers, letting them know that it was canceling this model, and will instead focus on making the $73,000 Adventure model. Customers who had already made orders could either upgrade or cancel their order, but had to do so by September 1st. This was said to be done because the company no longer wanted to deliver the Explorer package, so it could focus on as many vehicles as possible. What are we then to expect in the long term? Rivian brought in a new chief operating officer, Frank Klein, and is redrawing its organizational chart. The biggest change, however, is dividing its commercial business with one group focused on its B2B vertical and the other on its B2C vertical. Given its first mover advantage, it has the potential to capture a healthy chunk of the market as consumers transition to EVs. However, it is a long way from engulfing its deliveries, as the company continues to burn through cash at a rapid rate. Even if it were somehow to reach its 25,000 vehicle target by the end of 2022, this is still significantly lower compared to other companies in the automotive industry. With shares down over 62%, Rivian still has a lot of red flags, so you should definitely look before you leap. For more on what is happening with Rivian shares, check out our video titled Inside Rivian Stock. Will Rivian surpass Tesla stock? We'll come your way again some other time. Thanks for watching.